You have $1,000 to invest. Remember MetroCoffee and Daily Brew from our last video? On paper, they look similar. Both have attractive PEGI ratios, but MetroCoffee offers a juicy 10% dividend yield. Invest $1,000 in MetroCoffee and you will collect $100 in cash every year while you wait for the company to grow. Daily Brew pays no dividend at all. Most investors think, wow, that's an easy buy. I made that mistake in the past, and that's why today I want to talk to you about the dividend trap. Hi, I am Nick, the guy with the Greek accent, a long-time value investor and financial educator. Today we are talking about the dividend trap because it is the single fastest way to lose money while thinking you are playing it safe. We are going to see why MetroCoffee is a ticking time bomb and relieve one of the most brutal dividend traps in history, Citigroup. Stick with me because knowing how to spot a trap is just as important as knowing how to pick a winner. There are two ways a dividend yield goes up. The company raises the dividend, which is good. The stock price falls through the floor, which is bad. If a stock falls from $100 to $50, for example, the yield doubles. But a stock price can fall for many reasons: random fluctuations, a broader market crash, or a declining business. And this last one is especially important. That juicy dividend. When the business is quietly falling apart, it is not a gift, it is a bait. And the second the company can't afford the payout anymore, the trap slams shut. The math screams bargain. The reality whispers bankruptcy. You buy for the fat check. They cut the check. Now you are left holding a sinking stock and an empty envelope. That's how the trap actually works. It is like a mouse in a mousetrap. The sky-high yield is the cheese, drawing you in, while the falling stock price is the loaded spring, ready to snap, destroying your principal and eliminating the income you were chasing. Let's go back to MetroCoffee with that 10% yield. On the surface, it looks incredible. You invest $1,000 and you collect $100 a year. Daily Brew offers nothing. Easy choice, right? But let's dig deeper. MetroCoffee is trading at $50 per share and paying $1.50 per share annually. That's your 10% yield. But here is what most investors miss. That $1.50 dividend hasn't changed in 2 years. What has changed is the stock price. 2 years ago, MetroCoffee traded at $30 per share. The same $1.50 dividend meant a 5% yield, perfectly normal for a mature coffee chain. The stock price has been cut in half, and suddenly that 5% yield became 10%. The yield went up because the stock price changed. The dividend in absolute numbers remained stable. This could be a sign that the market sees trouble ahead for MetroCoffee. We have to be careful. But I can hear you say, Nick, MetroCoffee is a small business nobody knows. I only invest in blue chips. I am safe. Let me tell you the story of Citigroup. In late 2006, Citigroup was one of the biggest banks in America, with a market cap of over $270 billion. It paid a solid dividend, $2.16 per share every year. At that time, it was trading around $55. That gave you a yield of around 3.8%, a very safe, reliable bank stock, nothing flashy. In December 2007, the stock price was down to $42, so the yield was an incredible 5%. Analysts were saying the dividend was safe. A dividend cut was not even remotely possible. A month later, Citigroup announced a dividend cut of 41%, down to $1.28 a year. A month later, they announced yet another cut, down to 64 cents, and 10 months later, the last cut, down to 4 cents per year. So, in just 1 year, the dividend payout went down 98%, from $2.16 to just 4 cents. and the stock price, it plummeted from $55, less than $1 in 2009, a 98% drop. If you bought Citigroup in December 2006 for that safe 4% yield, your $1,000, now worth $20, your income gone. The experts who said the dividend is safe were wrong. The market knew. You paid the price. That is the brutality of a dividend trap. This doesn't mean all high-yield stocks are bad. It just means you have to look under the hood before you buy the yield. So let's go back to our fictional friend, MetroCoffee. Why did I warn you about it in the last video? MetroCoffee had 5% growth and 10% yield. Here's the question you must ask. Where is the cash coming from? MetroCoffee earns $1 per share in profit, but they are paying out $1.50 in dividends to maintain that 10% yield. That's a 150% payout ratio. They are paying out more than they earn. They are borrowing money to pay you. They are liquidating the furniture to pay the rent. Eventually, they will run out of furniture. That PEGI ratio of 1 looked great, but it is a false positive because the yield is unsustainable. So what happens next? Let's fast forward 6 months. MetroCoffee reports a disappointing quarter. Sales are down 20%. They have closed underperforming locations. Earnings per share went from $1 per share to just 80 cents. The board faces an impossible choice. Keep paying $1.50 in dividends and drain what is left on the cash reserves, or cut the dividend and face the anger of investors. They cut it from $1.50 down to 75 cents per share, a 50% slash. The stock, which was at $15, collapses to $7.50 as dividend-chasing investors panic and sell. Your $1,000 investment, now worth $1,500. Your $100 annual income, cut to $50. You have lost 50% of your principal and half your income in 6 months. The yield is still 10%. The trap is still here, ready to trap new victims. Imagine explaining to your spouse that the safe 10% income stock you moved the emergency fund into just got cut in half, and then the dividend disappeared. I never want you to have that conversation. So, before buying any high-yield stock, follow my checklist to avoid dividend traps. First, check the free cash flow payout ratio. In simple terms, you can think of free cash flow like your monthly salary after you have paid your rent, bought groceries, and put gas in the car. It is the actual pocket money the business has left over. This is the only money that can actually use to pay you. If a company is paying out more than 80 or 90% of this pocket money, the dividend is at risk. If it is over 100%, run away. They are spending money they don't have. Second, the yield spike. Look at the company's 5-year average yield. If the stock usually yields 3% and suddenly it yields 8%, that is seldom a bargain. That is usually the market screaming that a dividend cut is coming. Third, debt levels. High debt limits a company's options. When times get tough, the bondholders get paid first. The shareholders, that's you and me, get paid last. If the ship starts sinking, the dividend is the first thing they throw overboard to pay the bank. So, my friend, please, don't just chase the biggest yield like I once did. So, do you want to know exactly how much cash a company actually has available to pay you and spot the traps before they snap? Watch my free cash flow guide and you'll never get trapped again. Already know the basics? Watch my Intelligent Investor series. I decoded the best investing book ever written so you don't have to wrestle with 1940s English. Pick one. Either will save you thousands. I learned this stuff the hard way so you don't have to. Hit subscribe, grab the tool you need, and I'll see you in the next one.